Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing AT&T stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. AT&T is one of the largest telecom companies in the world. The company sold its HBO Time Warner division to Discovery this year. The new entity will consist of 100% of Discovery plus the Time Warner division. Discovery shareholders will own 29% of the new entity, and AT&T shareholders will own 71% of it. The company said the main reason for the divestiture is to become a pure-play communications company similar to Verizon and T-Mobile. Also, the margins are higher for its communications business versus its Time Warner Bros. Division. The company is headquartered in Dallas, Texas, and was founded in 1983. The ticker trades on the New York Stock Exchange, Mexican Bolsa, Deutsche Börse, Zeta, Vienna, Swiss, Colombia, EuroTLX, Sao Paulo, Lima, and Buenos Aires Stock Exchange. Let's get started with the model. This is a large cap company, 152 billion market cap. They're trading at $21 a share, and they have 7.2 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have 29 billion of free cash flow in 2019. That dropped to 20 billion. But still, 20 billion is a lot of free cash flow. Free cash flow is the cash that's remaining after paying all your expenses and investing back into your business. So it's the money that's left over for you, the investor. Net income is the profit or loss on the income statement. It's revenue minus expenses. That was negative in 2020. It peaked in 2021 at over 21 billion. It's currently 18.7 billion in the trailing 12 months. Revenue is a sales for the company, and that's been declining from 181 billion to 163 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that's also been declining each year from 97 billion to 87 billion. Below that is our operating expenses. These are all the expenses not directly related to generating the revenue. An example of this is marketing. Gross profit minus operating expenses gives you your operating income. And it looks like they have pretty strong operating margins. You can see their operating income was higher than 2020 with lower revenue. A big concern about this company is the amount of debt they have. They have more debt than any company in the world. They paid 6.7 billion of interest on their debt, which is a lot lower than 2019 of 8.4 billion. And with the sale of their Warner Bros. Division, they're going to be able to pay down a lot of debt. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. An example is an asset impairment or the gain on the sale of an investment. Then you have your pre-tax income, your taxes, and the bottom line of the income statement is your net income. And the only reason they had negative net income in 2020 was this large asset impairment. I would just focus on operating income when I look at the income statement, not net income. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. They generated 49 billion of cash flow in 2019. That's just a ton of cash. But even though it's declining, 38 billion is still a big number. They spend a lot on CapEx because they're constantly building out infrastructure. CapEx are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And that's why they pay such a high dividend, because they have a ton of free cash flow. And they paid down debt in 2019 and 2020, but added a lot of debt in 2021 and the trailing 12 months. Let's look at their capital structure. 169 billion of equity, 229 billion of debt. They have 42% equity, 58% debt. Their net debt is 191 billion. And I gave them the highest whack on Finbox, 8.3%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 224 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $224 billion. We divide that by 7.2 billion shares. And we get a calculated stock price of $31. They're trading at $21, so they're trading at a 32% discount. It's a buy according to the model. Their revenue is projected to be $123 billion in 2024. Also $123 billion in 2023. And their revenue target for 2022 is $126 billion. And I continued this trend into 2025 and I got $124 billion. That's how I got their future revenue estimates. Their revenue is projected to be lower because they won't have Time Warner anymore. If you owned AT&T stock before they announced the spin-off of their Time Warner division, then you now own AT&T stock and you own stock in the new entity, the Time Warner Discovery entity. They convert on average 15% of their revenue into free cash flow, so I multiplied their future revenue estimates by 15%. That's how I got their free cash flows. The website Simply Wall Street is really high on this one. Their valuation is $69. They're saying it's 69% undervalued. 15 analysts priced this stock and the average price target is 23, the lowest 17, the highest 27. This is where the stock has been trading the last 5 years. It was about $30 a share in 2017 and also the end of 2019. Then it dropped a lot due to COVID. It came back up, but when they announced they're going to cut their dividend due to the spin-off of Time Warner, lots of people sold off and the stock came crashing down. But you can see it's come up a good amount since this bottom. It actually did come up, then came back down. But then it came back up again, and it looks like it's heading north. They used to pay about an 8% dividend before the Time Warner announcement. Now they pay about 5.25%. They pay a quarterly dividend, and they're currently at 28 cents a share, which is 43% of their net income, 39% of their free cash flow. Here's a chart of their dividend yield since 2011. Their dividend yield was about 6% for about 8 years. Then the yield really shot up, mainly because the stock price came down. But they recently slashed their dividend because they got rid of Time Warner. And the forecast is for their dividend yield to be 5.2% by 2024. They've done 4 stock splits, a 3-for-1 in 87, a 2-for-1 in 93 and 98. And then this recent stock split from the divestiture of Time Warner. They have a beta of 0.74, so the stock moves less than the market. It's not volatile. It's gone down 4% in the past 52 weeks, while the S&P is down 1%. The 52-week low is 17, the high is 22. And the stock is trading above its 50-day and 200-day moving average. And you can see this is a really popular stock. Over 50 million shares are traded each day. Almost all the shares outstanding are on float. 54% are held by institutions. And over 1% of the shares are shorted. If you put $10,000 into this company 10 years ago, you'd have almost $15,000 today. That's a 46% return, a 4% annual return. The CEO's salary is $2.4 million, and their total compensation package is almost $25 million. There's only been one insider trade in the past 12 months, a buy for 100,000 shares at $25 per share. 54% of the company is held by institutions, 46% by the general public, and only 0.1% by insiders. Their employee count has been going down over the years. It was as high as 270,000, now they're a little over 200,000. The biggest shareholder is Vanguard at 8%, then BlackRock, State Street, Newport, and Geode. Let's look at their financial ratios. They have a PE of 8.2, that's stock price over earnings per share, a lot better than a market median and market average. Also a really good price to sales of below 1, and a price to book of below 1. And they have a really good price to free cash flow of 7.4. That's stock price over free cash flow per share. Their return on invested capital is a bit low at 6%. Even though they have a lot of debt, they can cover the interest payments on their debt almost 4 times. They have a good ROE of 11%. That's net income over equity. The market median is 7%. Their current ratio is slightly below 1. That's current assets over current liabilities. Same thing with the quick ratio. Even though they have negative $5.6 billion of working capital and they pay out $8 billion of dividend payments, they have plenty of cash flow because they generated over $20 billion of free cash flow in the trailing 12 months. The best way to look at ratios is to compare them to companies in the same industry. There are 64 companies in the same industry as AT&T, and if AT&T has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So you can see they're better than average in every single category except the revenue growth. They spend a ton in CapEx, they have a better debt to equity ratio, they pay a high dividend. Most companies pay a dividend in this industry. They pay a lot higher than average. They generate a ton of free cash flow. They're ranked third in market cap. They have a better price to book than the average company, a much better price to earnings, and their price to free cash flow is only 7.4, the average is 16, and a really good price to sales. So why doesn't everybody just buy the stock if they have such good ratios? Mainly because the stock price doesn't go up much. It's like a turtle, it hardly ever moves. So to summarize, I have them trading at a 32% discount, and this is a great stock for retirees because they always pay a consistent dividend, and it's a pretty healthy dividend. But if you're looking at 2x, 3x or more, you're probably not going to get it with this stock. I rank their free cash flow 7 out of 10, their revenue 7 out of 10, and their ratio is 10 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.